Recording. Good evening, ladies and gentlemen, and whenever the ladies arrive, we have three great members. We have Brian, we have Neil, a new member, and who's starting to learn, and this first step forward is huge. And of course, Repping Pants, who's been with us before, came back. Very, very happy about that. And this session is a free market update webinar as well. We're going to talk about some stocks. And of course, I'm going to have a little bit of a Q&A. Should last about an hour. I always go overboard, but don't want to stretch it too long. Full disclosure, this is purely for financial education and not for any solicitation or advice. Session will be uploaded to the Clueless 8 YouTube channel, which everyone should have their email in there. Subscribe. Obviously, it's a YouTube channel. It's free. And anytime I'm putting anything up there, you guys get automatically notified thanks to the Google robots out there doing their job. So make sure that you have your email on the Clueless 8 Trading YouTube channel, and certainly everyone else who can make it tonight will be able to review this very important market update webinar prior to trading on a beautiful Monday, 23rd of January 2017. So let me kick off by a couple of comments that I always make. And I think these comments are important because these things, I'm unscripted. I'm not reading from a script. I'm not sitting there planning what am I going to tell my members. I'm telling them what I see, what I feel, and what is going to help me, which certainly is going to help my people. It's as simple as that. So a couple of important comments about the market. 2017, I've said it before, I'll say it again. It's going to be a year of intense volatility. There's nothing to be scared of. You're going to be stressed, you're going to be nervous, and you're certainly going to be very confused. But the way you minimize that stress and confusion and the nervousness and the fear, okay, and the fear is going to be through your continuous learning and understanding of the tactical charts and all the trade alerts and stuff that I put out there. Most importantly, the charts, because nothing keeps me sane and keeps me paying the bills and living a very decent lifestyle than the Clueless 8 Trading charts and the structural and the structures that I put on it, and that is the most important thing. Jeremy has arrived. JP, great guy, old friend. Jeremy, can you hear us? Okay, JP, you can just follow along as you sign in. So one of the most important thing, Jeremy, there? Okay, he just typed in yes. Good. So for the first part, what I was saying, because you just came in, no, you're not late. I just started. I'm late. So we're talking about, we were just starting off with a couple of very important market comments. So 2017, and I've been doing this for a while, not as long as maybe some of the other services you follow, whatever, some of the gurus, who are out there, but, I don't want to be that old in trading, age, is the fact that 2017 is going to be a year of intense volatility. I mean really intense. Whether it's intraday, whether it's intra-hour, it's going to be really, really one of those years where you're not going to be sitting there saying, oh, all the news is good, why isn't it going up? It's going to be a year where you have to understand the levels. You have to understand where these robotics, algorithmic, high-frequency trading levels are taking the market, bouncing the market. We're seeing it consistently. But what we are seeing since December, and more so in January, I can't believe it's almost the 22nd of January. It's like going fast. Is the fact that if you're not tracking the levels, and you guys have all seen this, okay? You guys have felt it. And you've seen me talk about it. You've seen me constantly putting out real-time charts showing it. That if you don't know those numbers, what those levels are, you're going to get screwed. Excuse my French. Okay? Because this is going to be a year where you're going to see the patterns which don't even replicate themselves. I mean, I can't even describe some of the patterns. I mean, what is this frigging pattern that we're looking at? Okay? It's really not a pattern. There is nothing out there in technical analysis which tells you from here down to here, okay, from here down to here, what pattern is this? Yes, I can show you it's a mini it's a mini what do you call it, support, dragon bullish and all that stuff, but it's really not. This is a descending triangle down here. There's a big macro. You see the dotted lines here. That's a big macro sort of wedge. It's not. What the markets are doing right now, adjusting to the new paradigm, and that new paradigm is the Trump era. Okay, I personally think, and I'm a big student of macroeconomics, global and U.S. political and economic game theory. And what is game theory? Game theory in the simplest terms, like I explained to my son when he was 8, now he's 18 plus, is simply something you do and then you have different consequences. So the variables that go into the model, right? And my variables that go into my model when I'm charting and when I'm putting my trade alerts or putting the comments, excuse me, that the upside is intact or this and that. These are not just frivolous words. These are words that I'm putting there because I believe in them. And they've worked out most of the times. In fact, majority of the time. When nobody believed that it would work out, whether on the downside or the upside, it did. So so game theory is when you put a certain number of variables, you take an action, but they will have different outcomes. So you have to know what those outcomes are. So in the case of trading, those outcomes are what are the levels that we can drop to, what are the levels we can bounce from, because believe me when I tell you, okay, guys, you will be shocked and surprised, and you have been lately, on where the markets all of a sudden turn and where the markets all of a sudden drop from. It's going to be sudden, it's going to be fast, but as long as we know those parameters between the ranges they're falling or not falling, and where they're bouncing from, and it's not that easy, believe me. Forecasting is not easy business. What I do every single day, as in putting the real-time charts, putting those pivots and all that, everything, it's not easy stuff. I'm not complaining. That's my job. You guys are paying me a small amount of money to provide that service. It's capitalism. It's responsibility. That's my responsibility. What is your responsibility? Your responsibility is to track them as closely as possible, understand the dynamics behind them, and track them as closely as possible by looking at my stuff that I'm putting out there. Because no other service puts out real-time charts like I do. And that's a fact. Okay? That's a real fact, truth. But you have to replicate that on your own screens. In other words, you have to look at your own platform that you're using, and hopefully one that is mimicking mine. Doesn't have to be exactly mine, but hopefully it's a Thinkorswim or investing.com. Here, red's on the background right now. That's a real-time, e-minis that we're looking at. And as we are talking, that's what's happening in the Globex markets. And try to understand that, okay, it's not the end of the world just because it breaks a certain level, and it's not the best of the world because it breaks above a certain level. Because I'll tell you one thing, I've said it before, 2017, and I mean now, I mean more so going into this week, you're going to see more false breakouts and more false breakdowns than you've ever seen in your life. What does that mean to you? It means that if you're doing trades, okay, if you're doing trades, that by the way is a, just so you know, that's not E-minis. That's an actual S&P 500 chart as of the close on Friday. And we'll go over that in a minute. I mean, over the next couple of minutes. Okay? And I already posted that. So this is the dynamic chart. So the bottom line is that's what you got to do. And I know I harp on it. I sound like an old fart, excuse my French. But you know what? I'm trying to help because that helps me. So why can't it help somebody else? Some of you guys, in fact, a lot of you guys are a lot smarter than I am. Believe me when I tell you, you're successful in what you do and you're doing well. We have great members who are doing I know some of you guys, personally, and making a lot of money doing what you do as a real-time day job. But when it comes to trading, few of you actually beat me what I do. All right. So just use that same type of brain power that you do in your real job in 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 understanding what you do. Because one thing I learned a long time ago, and I've been in both sides, right? I've been a salaried employee for a long, for a while. Had a boss, and I was my own boss for a bunch of years in the latter part of Wall Street. But when it comes down to it, nothing beats trading. It is you're your own boss. You're writing your own frigging paychecks. We're capitalists. We write our own paychecks, and nothing beats writing the fattest paycheck in the world than if you're doing what you're doing. But you got to do it as a business, not just as a joke. End of story. So now we dive into it, into the technicals and what I think is going on, and we move from there. Before I get into it, one important thing here. I believe, and this is very important, regardless of what you hear in the media and everything, whatever media you're listening to, this and that, I believe that some of the more practical promises of the new administration in corporate reform, in the form of corporate tax repatriation, corporate tax cuts, capital gains cuts, cuts in federal spending, or I should say wasteful federal spending and such, is going to come to fruition. But here's the problem. Markets always judge these things and move forward. That's why here behind you, you're seeing a phenomenal chart of the E-minis, which is S&P 500, on a monthly basis, and you have a powerful, powerful bull flag, especially these two bars. These are monthly. This was the month of December. This is the month of January. And no one can deny the fact. You can show somebody who's completely non-technical and look at this and tell me, oh, that's a really crappy looking chart. No, it's not. It's telling you that it's at least going to get up towards these levels, which is 2298 on the upper end, or you can slide it back a little bit and say 2300. So as being the E-minis, you have to add 5 or 6 more points to it to arrive at the SPX number. So 2301 would be 2306 on the S&P 500. 2306, that's great. This is not a deconstructive chart. This is a constructive chart. But then when you zoom in, that's when you start to see, where things are. This is a monthly. None of us are really, let's face facts here. I'm a swing trader in a certain degree. I'm a day trader when it comes to indices and when our Teslas and stuff move really fast. But at the same time, I'm keeping an eye on the bigger picture. So, but I'm not going to be sitting here buying putting in a whole bunch of my trading book into a monthly position going out a month out or 2 months out and say, oh, I think the market's going to go there because, this looks this good. No, I'm not that stupid. And I'm not that much of a believer. And I think all of you should be like that. So when you hear services and stuff and gurus out there, there are other forums that you follow, tell you, oh yeah, the market's going to be this much higher or this much lower, by late February or March and stuff, they have no frigging clue. Because volatility, which is manufactured, and which is a direct consequence of political and economic and external international events, especially now that a new administration is in power. Every tweet matters. Every comment matters. Every policy initiative matters. You're telling me you know where the market is going to be in end of February or March and stuff? Sure, I can give you a nice cockable story about where it's going to be. And I know I can sell that bill of goods real fast. But I'm not going to lie. I don't know. So I'm going to keep things close to the vest on what's going on. Keep on showing the bigger picture. Tell people to manage their position based on those very specific technical levels that we are trading in. And that is going to be the purpose of this session. So is that okay with everyone? Does everyone understand what I just said?
Sounds good, boss.
Okay. All right.
Yeah, fine.
Yep. And I make it simple. I don't make it complicated because I'm not that complicated a technical guy. Okay, I see things that have worked for me over the years, and that's it. That's what I share. So let's start off by looking at the broader picture, because that's what dominates what we trade under. Of course, there are specific stocks that we can go ballistic regardless of the market being down 200-300 points, but that's a different story. And we'll talk about some few stocks too. So this is a monthly chart. This for me gets a check. It's good. It's a rising wedge. We tested the bottom of the wedge. We have a possibility of getting to 2,300. That's good. So that monthly chart is looking good. Nice fat. I mean, this is a monster reversal of the October lows. And this was October of 2016, gentlemen, not October of 2017. All right. So this is great. Massive hammer reversal. And the continuation pattern. You can see that continuation pattern. Yes, we can fall a little bit, maybe 60, 70 points, 100 points. We're still within the framework of what's going on. Now, let's move on to the weekly. This was, believe it or not, 2016. This was 2015, actually. 2015, we had a big high yield rate scare. Forget about it. I mean, it's just like, boom, double bottom, similar patterns, double bottom, massive, what we call a W formation, known as a dragon bullish. I don't know why they call it dragon bullish, but still, I'll take it. Same thing happened at the beginning of the year. In January and February, we hit 1,800. I thought we were going to slip a little bit lower. No, got to respect the candles. Massive candle reversal on the weekly. Now, in hindsight, everything looks so clean. That's the difficulty about trading. I want to interject this very important thing here. We can paint a beautiful picture on looking back everything in hindsight, 2020. Oh, wow, look at that dragon bullish pattern. Look at what happened, this and that. While we're in the middle of battle, and some of you know I'm a big, huge supporter of our armed forces and our men and women in uniform, because they're the ones fighting the battle. In the thick of, you can sit there in West Point, get a, like an A+ on every single class. But the guys who really win, the guys who can put things together and stay calm in the middle of the firefight when the enemy is trying to decimate you. So that's trading on a daily basis. The algos and the high frequency trading programs are constantly trying to get you off the trade, scare the living daylights out of you, and get you out of that. They do not want you to make money. And we still do. It's a pretty amazing feat. That's the battle part of it. That's a real battle. Now, this is the planning part. We're looking at it. We're understanding the patterns and stuff. Patterns replicate. They don't replicate exactly the same way. So I just want you guys to understand that. That's what makes it difficult. That's what makes it difficult. That's why sometimes traders say, well, you said, it's a swing trade. It's going to get there. Yes, but if you're up 50% on it, which happens on, I would say 80% of my trades, whether it's a Tesla or Amazon, and you're shooting up, what, are you going to sit back and say, oh, you said it's going to go to, $860. I'm going to sit back, and that's stupidity. You've got to take your profits in. You will use part of those profits or whatever you do. I'm not in the business of telling you how much money you're going to put in the market, especially when it comes to options trading. That's guerrilla warfare. That's hand-to-hand combat, okay? And then you're going to decide, okay, I'm going to put a little bit in there. That's what I do. So if something moves up that fast, that quick, right after I show it, then it's your responsibility to manage your profits. That's why the term MYOT comes in. Some of you might not know that who are new. MY simply means manage your own trades within the context of what I'm putting out there. And that's how I put it, MYOT. Right? So you got to manage your own trades. If I'm giving you an S&P call that's going out, that's at $2.50 or $3, and within a matter of 25 minutes, it's at $6, what are you going to do? And say, oh, you showed the chart, it's going to go to 20 bucks. It will go to 20 bucks most probably, based on my predictive game theory analysis and the charts that I show. But what are you going to do? You're not going to take something that you bought at 3 and it's a 7? And that's a 250% on your money? It's actually 150%, based on the fact that, actually the actual true percentage is 150%. Okay? So what are you going to say? Oh, I'm not going to take the 150%, because the chart showed that. So that's for you to decide. Some people do. I know some traders in our group who basically just say, I'm going to swing it because that's the way your charts have shown. I'm going to stick with it. So they don't care that it goes from 3 to 7, drops down to 4, or maybe, oops, sorry. Let me just do this. So it goes from 3 to 7, and this is reality, okay? 3 to 7, drops down to 2.5. Now, swing traders who are really tactical understand the charts. They're like, okay, I'm bulking in, buy more here. So they're reducing their cost basis lower. So it's no longer a $3 cost basis. They're maybe bringing it down to 2.5. I mean, they're bringing it down to 2.75, I'm sorry. And then it jettisons up to 7, but maybe it takes 4 days. Maybe it doesn't take 1. I would rather be one who takes the bulk of the profits between this fat move, take a little bit of money, leave it in there. I don't know it's going to swing back because that's volatility. Goes up, goes down. These are more of the swing charts pictures that I'm showing you. And as I go along, I'm going to go from the weekly to the daily to the hourly. That's when you start to see the real noise. What is noise? Noise is volatility. That gives you those panic heart attacks because you put too much in something and then it's not working in the next 15 minutes. And you're going for your adult diapers, right? That's reality of trading. So they'll buy it here and then they'll make a crap load of money because it does go to 7, but maybe it takes 5 days. And 5 days can be very nervous if you have a lot of money in an option trade, especially when it relates to fast-moving stocks, high Momo stocks, as we call it, or indices, SPX, RUT, QQQ. Everyone clear on that? Yes? No?
Loud and clear, boss.
Okay. So just,
got it.
Yeah. So we're talking about the realities of what happens. So here we are on the weekly. Now, when we close into the weekly, we're not seeing like big, fat, green candles like we saw on the daily charts. I mean, sorry, the monthly charts. Why? Because there's more noise. As you zoom into a microscope, any of you ever take a biology class back in high school? Has any of you actually seen through a microscope? I'm just curious.
Yes, I have.
Yeah? Well, anyone hasn't? Just curious. No? Okay, everyone's seen it. Great. So what do you do when you see it through a microscope? You see this one of these little slides, and there's maybe a little, speck of whatever. As you zoom into something, it looks nastier, messier, noisier. It's the same thing with trading. You're looking at 5-minute charts, you're looking at 10-minute charts, you're looking at 15-minute charts. It is full of noise, and candles are not candles. They're just like monkey on hot tin roofs. So it makes you, as a trader, a monkey on hot tin roof. So it's good to have a eye on the bigger picture, but not focusing too much on the noise that's going on. But unfortunately, this is the reality of what this market is now and has been for the last couple of years, that these machines that control the market deliberately create massive volatility. And it's not the trader's fault all the time. In fact, most of the time, it's not the trader's fault. Sometimes it is that they get completely blown out of a position while that position still works, both on the long side and the short side. And that is the truth. So yes, it's okay to be microscopic, but not to the point where you're like just going nuts. So this is not looking like all kind of nice little candle, blocks. This is showing a This is a weekly chart. This is starting to show a flag. Yes, it's still a bull flag, but it's still a rising wedge. What does that mean? It means that if we hit certain levels like 2250 or so on the E-minis, that's roughly about 2255 or so on the S&P. You have to add 5 more points to it or whatever to arrive at the actual value of the SPX. You're going to break down. And that breakdown could be fast, swift, or severe. You have levels of support that's at that's here, 22.25, and these are weekly. If I said somebody, oh my God, the market is going to be 22.26, and we're not positioned on the short side, that's a deadly. You're going to get blown up, at least on that position. So 22.26 or 22.27, which is roughly about 22.30. 2231 on the S&P 500 is a very critical level because it might not look like that so much on the weekly chart, but once you hit that level, okay, once you hit that level, I don't care what stock you own, you're going to get hurt. And you can be sitting there acting like you don't know what the heck's going on. That's why levels are important. It might do two things. It might just come down here, test this very strong support, bounce hard, attempt to get back into the wedge, into the rising diagonal, the wedge, continue higher, fail. Next scenario 2, it fails, comes down here, attempts again, maybe doesn't go that far, then breaks down. And that breakdown can bring you down to 2180, which is roughly about 2185 or 2190 in some cases on the S&P 500. That's devastating. You get blown out. Your book, if you're not careful, will just be decimated. So just giving you examples of how important, why I stress so much on all of you guys, stress it so much and push it so hard that you have to watch the ES, which is the E-minis and the S&P. And once you start to, and you don't need to be E-mini trader. S&P trading is as similar as E-mini trading, except it's happening in the daytime. They're equally fast. And we'll talk about on Friday. Had one of my biggest trades when I went hard on the short side, on the second candle, and covered it for almost 70%. But I went hard on it, and that means the size was reasonably big. And boy, was it a sweet ride. And it wasn't a sweet ride for the first 20 minutes because I'll explain to you. Because it went down and then just jumped up so fast, I went from being hugely positive to being flat to slightly down, but that's when I went in and added a couple more based on multiple charts that I posted out for you guys, which I cannot show here because it's my other CPU computer, which is to do with the quad algo HFT platforms. They told me that, yes, the market will bounce, but it will still fall. And it did. And the second time, I was out. And it felt good. It was a 25-minute trade. And those 25 minutes were pure attention and scary because it was very volatile. So anyway, on the weekly chart, you're seeing this. We break this, which is 2251, roughly about 2255 on the S&P 500, then you're going to fall. And that fall is a lot of money if you're positioned right. And you know I'm always there to alert, but I don't know whether it's going to do it or not. Let's move on to the daily. Let's look at the daily chart. More noise now. We're starting to see the noise factor. So here's your Trexit, as I called it, the Trump election exit. Oh, the world's going to fall apart. It's going to end. Trump's coming to power, you know, this and that. I expected it a little bit lower. In fact, it actually did go lower because 2026, because they halted the market, as you know, after hours. I don't know if, you know, I have multiple charts on that on my my Twitter feed. Also the video cast, real-time videos of what was going on that night. And I knew the world was going to fall apart. Okay. And Massive hammer reversal on November 9th. You can see that right here at the bottom, right there. We opened down 100 points, but then we started seeing the reversal, and we were in there. Were we in there blind, like put everything that you have, like, you know, Ocean's 11, like just shove it on the table and just lose everything? No, we just said, go in there, tactical. We're going to get a massive move over the next 24 to 48 hours, which always is the case on a reflex bounce. And that's exactly what happened. Some of you made a ton of money, and you have told me what monies they made. And boy, that is fantastic. They could have just said, you know what, I'm done for the year. It was huge. Okay? Or like we say in New York, huge. Really huge. And then the market drifted higher. So here's your daily, here's your daily chart, and move back to the daily, and you're starting to see some noise, and the noise means volatility. That noise is telling us we have some very important levels to watch. Remember, add 5 points to every E-mini point to understand where you are. Very, very critical level here, 2248. On the S&P, that's 2253. First S1 support is at 2252. That's 2257 on 2257 or so on the S&P. You can see what's going on. Just have to click your mouse and follow all the lines that I'm drawing, and then you put them on your screen. Because once we break these two levels, we're going to fall rather quickly to the bottom of this. I have to adjust this line, obviously, because it's a daily. So let me try to do that. Sorry. Let's do this. A little patience here. There's a couple of uptrend lines. There's one here. And there's one here. These are uptrend lines, so they cannot be red. They have to be white or blue. And bingo. And now we have a picture. So right now, and this is nothing new. It's not the first time you're seeing these things, because I've been posting multiple charts on similar format. I mean, on similar levels for weeks now, if not for days, including last week. So we are in a major trading band right now, which I'm going to show you on my other. There. There you go. That's your trading band. Your trading band is 2247, 40, let's round up the decimals, 2248. So that's in S&P terms is what? Somebody tell me.
2253.
Thank you. Thank you. Okay, so 2253. Write that down. And that's a very critical level, I'm telling you. 2250 or 2053 is a very critical level on the S&P 500. And thanks for mentioning that. So, and then on the upper end, we have on the highest end, we have 2277, which is basically 2282. And believe me, that's exactly how the market's trading. That's how the robots are controlling. That's where the real money is trading. They're not trading BS coming out of CNBC or, I'm sorry, CNBC or Bloomberg or whoever, or StockTwits or other forums. They're trading these exact levels. And of course, this 2225 level, which actually is 2230 on the S&P, is very critical. We break that, please short for at least 7 days and make tons of money, because the market at that point will attempt to hold this breakout level that happened here, which is roughly at, I don't want to go that further because I don't know if that's going to happen immediately in January. I'll tell you my forecast, what I think is going to happen. This is roughly about 22.20. So 22.20, if it really breaks, we're going to go down to, we're going to fall another 150 points. It's a lot of money. Once this line is broken, you're going to see panic. This line. Okay, you can write that down. That's 22.30 on the S&P 500. If 22.30 on the S&P 500 breaks, there's going to be stops triggered. There's going to be just random technical selling for no reason other than the fact that the late longs are going to be trapped, and it's just going to fall really fast. And that's when the end of the world guys are going to start crawling out of their bunkers, and it doesn't matter because it's all about levels. So this is the level we're trading in, okay? Right here and right here. And that's 30 points. And what's 30 points in Dow terms? Does anyone remember? What's 30 S&P points in Dow terms? Roughly. Take a guess.
35, 36.
What?
It's about 5 to 6
500.
points.
No, don't just take a random guess. See, this is really critical. You have to know the correlation between the E-minis, the SPX, and the Dow. In other words, what is the exact measurement? Because if you don't know that, let me just explain this very clearly. Then you're going to freak out every single day that you see the Dow down 100 points, 60 points, 70 points, 80 points. It is the most important thing that you have to take away from this session. And I've explained it many, many times. I'm not holding anyone to it. I'm just going to explain it because I don't want random answers. One S&P point roughly, is 6 to 7 Dow points. Simple. Okay, so if this is S&P, just to make things simpler, this is 30 points here, right? Roughly 30 points. So what's 30 points on a S&P, on the SPX? What is it on the Dow? I just gave you,
180.
Huh? 180. Exactly. Exactly. This is one thing that you have to know. Simple as like counting the dollars when you're paying for something. All right? If somebody tells you how many quarters in a dollar and you're like, 9, 10, 6, 4, well, even the guy sitting in Gambia or Congo or Sierra Leone knows how many quarters are in a US dollar. So we need to know that, okay? Real important. So yes, so the conversion rate is roughly about 6. That's the conversion rate. So 30 S&P points is roughly 180 to possibly 200 Dow points. So if we fall 200 Dow points, it's not the end of the world. That's what I'm getting at. It simply means that that's the range that we're trading in, 200 Dow points. That's why I don't freak out. Well, I seldom freak out. I freak out when my wife is really mad at me. Yeah, that's different. Just kidding. Okay? Seriously. I don't freak out about the market anymore. I used to years ago. I don't like it when my positions are down, but I don't freak out. I take tactical moves, stay calm, reload, and fire. And that's what all of you guys got to do. That's where you make the real money. But you have to know the levels. You don't know the levels, you don't know when to reload. It's like that movie, Magnificent Seven, right? My wife actually rented it this weekend. I thought it was like another frigging, hee-hum, cowboy movie. That's a damn good movie. It was strategy. It was planning. And I'll tell you about another movie that we saw over the weekend, which is a must-watch. But aside from that, you have to know the levels. And I know you guys are appreciating what I'm telling you, because if you don't know the levels, you don't know the conversion, and you see the Dow down 100 points, you're like, okay, here we go. Well, here we go means nothing, because 100 Dow points, I'm not minimizing it, because individual stocks can be far lower. Okay, we've seen that. 100 Dow points is only about 16 S&P points. So it minimizes your fear. That's what I'm getting at. Now, let's get back to it. So we are in a range right now between here and let's say at the lowest end, 2248, on this range here, 2276. That's roughly 30 points. So we're roughly in a 200-point band, a 200-point band. Does that look really scary when you look at it from a technical standpoint? And I want an honest answer from each of you.
No.
But it is scary
No.
if you're holding positions, and I've been there, okay, where it jostles around big time, right?
Yep.
Exactly. So as long as we understand that, as human traders, we're okay. Because this range is nothing out of the ordinary. All the market's doing is consolidating. So a 200-point range isn't the end of the world. Yes, if it breaks below this level, it is very possible that it drops rather sharply down to here, where the last major support level was back at the end of December, when we had those 3 days of incessant selling, if you remember, where we hit this low here, when we hit this low, December 30th. Okay? And if you remember, I was a buyer, because I'm showing you one chart here on the Thinkorswim, but I was showing you all the McClellan oscillators. I was showing you the slow stochastics, really oversold. And I was saying, take the long position. And can somebody remind me what happened on January 3rd when we opened for business, where the S&Ps opened up, when it all looked like all hell was going to break loose, but the technical indicators was telling us? Can somebody remind me what happened on January 3rd?
S&P was up in the morning.
Oh, thanks a lot, man. That's like saying the sky was blue. I'm asking for numbers.
Over 10 points.
Yes, thank you very much. It was up 18 points. We were long S&P calls around 4. We sold it close to $14. The ones who did it. And I remember putting down a thing saying, I might not need to trade for the month. And I wasn't even that loaded. I mean, in the position size. So guys, it's time to wake up, okay? Because the fact is that when it all looks like gloom and doom, just like what's happening on the S&P 500 right now in front of my eyes, the ES Mini, right before I started this session, was down 11 points. I'm not sorry, 11 points. Yeah, it was down almost 8 or 9 points. Is now about to go positive, only down 4.25. In the meantime, gold is still up 11, which we're going to cover tonight. On that note, just give me a quick second. I just got to take care of something. 1 second. Thank you for your patience. So bottom line was that it wasn't just fluke. It wasn't luck, just random, like, oh, the market's going to go higher in 2017. It was based on some very serious technical indicators, which are not shown on this chart because that was shown on my quad charts repeatedly that on December 30th. So even a few calls would have made you extremely happy, more than happy, extremely confident, so that you could go forward with the next trade being extra confident and making money. Because when you lose money on a certain trade, and I know that because I'm a trader, but I manage my confidence like nobody's business, okay? Is even when I'm feeling like the crappy, my only voice in my head says, I'm going to attack the next trade and make a crap load of money. Now, many of you, when you lose money on certain trades, and especially if you have a little bit too much in it, get despondent. And that's a human reaction. I respect that. I'm human. I'm not an android like from Mars. But if you live on that without understanding what is happening in front of you, these are robotic-driven markets, then you shouldn't be a trader. That's why most people are not traders. You think most people can be traders? You can take the smartest guy with an IQ of 170 or frigging 200. I don't know if anyone has an IQ of 200. And they'd be the shittiest traders in the world. It takes grit. And the grit comes not from going out there pumping iron. You got to pump iron in your brain. And the only way you can do it is by understanding technical analysis and the levels that are being posted and many other things behind it. So I hope you guys appreciate that, okay? Because, like I said, I have no motive in, I'm going to move on to the hourly right now. I have no, this is the real deal. So this chart for many of you could be like, oh, whoa, look at that. To me, it's poetry. It's bad poetry, but it's poetry because it's like I can see what's going on. So going back to it from a behavioral standpoint, a bad trade where you lose a bunch of money, and we all have it, and we all do, can screw up your next trade so badly, it's not even funny. The only way that you can minimize not minimize necessarily your losses, because sometimes it's not your fault. Like I tell myself, it's not my fault sometimes. We're in a perfect type of, not perfect, but close to a perfect type of a trade setup, and then the market hits just from nowhere, like a black swan event, hits you on the head with the hammer. But if you continuously keep on disregarding tactical charts and levels, you will in 2017 be the most miserable person that you have known yourself for your previous life. I'm telling you that right now. In the meantime, if you do understand the technical levels, and I'm doing the hard work of showing everything, you just have to put the hard work of understanding them and respect the fact that there is going to be severe volatility. You're going to be the happiest person in 2017, and I don't care about the fact whether you like Trump or not. And that's a fact. All right? 2017, in my estimation, is going to be a phenomenal year, purely for tactical traders, especially of what I do here to help you guys. If you disrespect it and you keep on doing the like stupid, just completely all the time watching prices, you are going to get decimated. And what's going to eventually make you do, you're going to hate yourself. And I know some of you do hate yourself because you can, oh man, every time I buy it, it goes down, because you're being stupid. You're not tracking and really respecting the levels that the robots are trading in. And the robots know very well where you scream in pain, where you run for the diapers, or where you get too excited. Like, oh yes, the market's going to make new highs. They know exactly where to smack you. And that is where the 1 hour chart comes in. And I've shown this repeatedly, but I'll show it again. So please respect that. And by the way, when not respect it, follow it for your own sanity. Because in this business, I said it a long time ago back on Wall Street, I used to tell my clients, there's a method to the madness. If you focus on the madness, you are finished. And that includes investors. You focus on the method, you're going to be a powerhouse. A powerhouse. You'll attack any market, good, bad, ugly, like we do here. So let me construct this very quickly. And this is not the first time you've seen this chart, but we're going to walk through it. This is the most important chart you're going to deal with for this coming week going into February. Guaranteed. That's the only thing I can guarantee you. Every level is going to be super precise, and I'm going to just walk you guys through it. Hopefully I'm not on mute while I'm talking. Everyone can hear me?
Yes, boss.
Okay, that's good.
Yes.
Yeah, because sometimes I get into my real zone and I'm talking and my mute button is on. I'm like, oh crap. Now I got to go through the whole thing again. So this is where we are right now, guys. All right. And let's do this together because we are in this together. We're a team. It's a Clueless A Trading Club. It's a team. So we are basically, as you can see, we are seeing multiple sort of repeat formations of inverse head and shoulders. That's a good sign. Just the way we saw, because after this chart, I'm going to go into the 15-minute chart to show what happened on Friday. Right? Where it looked like everything was going to just finish off, and then it kept on bouncing on the pivot, like JP correctly pointed out. Okay, looks like the pivot's going to break, not going to break. And when it didn't break the third time, I'm saying it's going higher. I could be wrong. I mean, I was right completely on Friday. Monday, I could be wrong. But we'll talk about what's happening right now in front of my other screens. By the way, gold is up $13. It's hitting exactly where I said it's going to hit. It hit it once before, 1220. Gold's going higher. So anyway, so you have a head, you have left shoulder, right shoulder. Here's your neckline, breakout. Now breakout doesn't mean it's like, woo, straight line up. A high of the day, as JP likes to say, does not mean it's going to make another new high. It's a different world we're living in. So guess what happens? There were previous resistances here, and we got close to it and banged down. What happened here? Head, which is exactly where the breakout level was, right there. This is where the poetry comes in. This is technical poetry, right? This is where the breakout level was, which is the neckline, comes down to the neckline, bounces. Left shoulder, right shoulder. Give or take a point or two, exactly the same. Neckline, bang, goes straight up. There is a previous resistance out there, which is the all-time high on the S&P, on the E-minis. Okay? Can't go past that. Goes down. Massive volatility. Goes up. We all think it's going to hit the previous high. Nope. Fails. Creates again a head, left shoulder, right shoulder. Except this right shoulder doesn't even get to the neckline. Does this. We walked through all these minefields and still made reasonable money. Not easy, but we still did. So at this point, we have a major reversal, What day was that? It was Thursday. It was Thursday. Look at the date here. It was Thursday, December 12th. I always said, middle of the month, give or take a couple of days, massive volatility. I mean, this was hard. I mean, this was like bang. I don't have every trade in my head, but this was a nice short trade, okay? Because we dropped from 22.66 all the way down to 22.47. That's 20 points. Can somebody give me a rough guess on S&P intraday or weekly puts, what kind of percentage returns that is when you drop 20 points on the E-minis or 20 points on the S&P?
300%.
Yeah, like 200% plus, depending on the premiums. Yes, you're correct. You're absolutely correct. Okay. So what does it create at that point? It creates, again, At this point, this is like a complete V-shaped type of move. Yes, it has a minor head and shoulder pattern thing. Doesn't matter. It hits the top of the range, which was this range. Can't go any further. Right here, non-technical traders and some in our group too, who who are just letting their emotions take over, are super excited. Wrong time to get excited, because right there the algos are dropping the JDAM on you, and bang. So what I'm getting at is this is severe volatility. You've heard the best of the fun guys say, we can't really trade this market. Who to say still trading the market? Is it easy? Absolutely not. I'm on my toes all the time. I'm doing smaller lots, bigger returns. Smaller lots, bigger returns. I'm taking profits fast. I mentioned that repeatedly. Manage your profits. Don't go overboard. No oversized trades. Because there is no exact trend. It's range. Range trading decimates people who are expecting breakouts or breakdowns. Something very, very important that I learned years ago, and more so now. Range trading means they're going to chop. They say, oh, it's a chop fest. Yeah, what's a chop fest? Go to Benihana and have some chop fest, I don't care if it's a chop fest. And then I hear from traders, especially in other forums, not as much in our thing. Oh, buy the dip. Oh, yeah, great, buy the dip. What dip are we buying here? If we don't know the levels, what dip are we buying? We're buying some, salsa dip. What dip are we buying? You have to know the levels. When you know the levels, yes, you're a dip buyer. But if you don't know the levels, yeah, buy the BTFD, buy the FDIP. Yeah, great. And you see that a lot in the other forums. So if you know the levels, then you buy the dips. Yes, absolutely. But then that levels are not just the charts, it's the internals. Are the Stows overbought? Is Mr. Stowe cooperating? All kinds of stuff that I put out there. So you can't just say, oh yeah, we're definitely buying the 2258 because it looks like the market definitely doesn't want to go below that. Yeah, that's exciting. In the meantime, S&Ps are like trading like monkeys on a hot tin roof right now, down 6 points. They were down more lower, and we could very easily break that tonight before this session ends and hit this level, which is an important one on the E-minis. Okay, right there, which is 2252. We're at 2260 right now. Is it possible by the time the session ends, so not too long from now, that we're going to be down 14 S&P points? No, because it's all within the framework of what's going on. We don't want it to break this secondary trend line, uptrend line, the blue line here, but it's not what we want. So the markets want to do. In fact, the best scenario would be, can somebody tell me where the market opens and then we go long? What's the best point you would expect? And how many S&P points would that be? Right now we're down 6.5. We're down about 6. Yeah, we're down 6.5 S&P points. We're right here. This is a dynamic chart. Can somebody tell me where would be the ultimate buying point and in the morning on Monday morning, tomorrow? And can somebody just take a quick look and tell me?
2248.
Right here, right?
Well, a little bit lower. Yeah, right there.
Bingo.
There.
There's Corey, man. You said it. That would be the boom. You put in a couple of $100, put in a couple of $1,000. I don't care what you put in. You're going to get a immediate, in my opinion, an immediate within 15 minutes, which you have to be quick though, or 20 minutes or half an hour, whatever the case may be, 40, 50% return on your money. Thank you, Corey. So absolutely, absolutely. This would be nice too. Now, does the market make it that easy? No. Of course it's not going to make it that easy. Now, 2240 would not be very nice because the longer position that we have on some swing trades and stuff would get also hurt depending on what type we have if we get to 2240, which is a major inflection point. So when you after the session, I know a lot of people are going to start tracking the E-minis, and you should be for your own good. At 2240 is like, yes, baby, give me the ugliness. I'm buying it because you're going to get a major bounce. Now, what is a major bounce? So a major bounce means, oh, we're going, oops, sorry. That's my keyboard came in the way. The major bounce mean like it's going to be like lace? No. The major bounce means that we're going to bounce about 10 to 20 or at least attempt to enter the broken up trend line. But that's a lot of money. Look, I'm a simple guy, all right? Worked all hard of my life and done well. So I'm not looking for the moon every single time. There is no moon. There are little moons you got to go for. So these are the little moons, okay? So if you get 15 points on it, that's about 120% on your money. Put a little bit in, take it out. But you have to know the levels. You have to know the levels. And God forbid, we actually have a crash. That's a crash, by the way, if we drop from here to here. Because that's roughly 200 points. Yes, from 2260 to 2230 is roughly 200 points. As we have established, it's roughly 5 or 6 Dow points for every E-mini or S&P point, right? So 30 points times 6 is 180 points. That's a nice little crash. And that would be a powerful buying opportunity for a reflex bounce. So how do traders manage volatility? That's up to you how you do it. That's something I can't teach. All I know is one thing. In these type of markets, don't go overboard with your size of your trade. Swing trade is a different story. You believe that Allergan is going to be a great company. It is a great company. You believe Palo Alto Networks is going to be the hugest beneficiary of more internet cybersecurity. Great. Those are ideas. Those are swings. We're going to cover gold right after this. Gold is a macro trade. I've been saying it since the JNUG was 190% lower. 90%. That's in a month. Okay? So those are macro trades. But the volatile trades, you just got to manage it on the levels. So that's where we are. Not easy, but understandable. And once you understand, it'll become easier. Are you not going to be stressed when you put trades in? Absolutely you will be. But please don't be overtly terrified because the markets are not ready to completely crack yet. So that's your 1 hour. Let's move to 15 minutes just quickly. Now you see the real noise. It's like it's a EKG, right? It's just like bang. But at the same time, you're seeing where the turns are coming. Now, can somebody answer me in very simple terms? Why do these reversals happen? And for E-mini players, you always have to watch the volume. It's very simple. That's capitulation when everybody basically just not just goes for the diaper, but falls down the toilet. All right. You got 170,000 E-mini contracts like sold at 9:30. Buy time. Now, why do these type of spikes happen? Why do you think? What are the two major reasons?
Short covering.
That's one reason. What's the other reason?
It looks like you also hit the uptrend line.
No, Corey, you don't answer. I want somebody else to step up. You gave one very good reasons. Yeah, of course, short covering. Somebody who shorted up here is saying, okay, time to cover, which means time to buy back my short position. And what's the other reason? When it comes to levels where things bounce from, what's the other reason? Not just short covering.
Trend lines.
Yeah, but what are trend lines? You're giving the answer, but you're not giving the reason behind it.
Algos?
Of course, they're just a facilitator of momentum. But what's the real human reason why things bounce from a certain level? You guys all have the answer. You're just not thinking the right way.
The stoves bottomed out.
That's great. It's another great technical answer. But stoves are not not like a living being. They're just a manifestation of somebody else doing something. This is like this is like a behavioral dynamics class at Harvard, business school. But think
Jeremy said support.
okay, you guys all give me technical answer. What's the human reason why things bounce at a certain point? Hey, listen, if you guys give the right answer, your girlfriends, your wives, your partners are going to be very proud of you. They're like, "Wow, you finally got to know me." Okay, I'm laughing. Here's a simple reason. There are buyers at that level. Okay? There are buyers at that level. That means they believe that the value is okay to buy at that level. That's why. Yes, the short covering comes in, this and that. But at certain levels when stocks bounce, like at 180, 190 Tesla, they're like, oh, short it is going to go to 150. I heard one guy sent me a PM. I think it was a free trial member, and then some member too who are real Tesla haters. Okay, oh, that's it. It's going to 150. I'm like, great. We're going to look at Tesla too tonight because I think it's going to be one of the biggest, like, it's already a huge winner for us over and over. It's going higher. So it's like they're buyers. The so-called smart money or whoever that is says that is a number that I like to buy on the valuation, blah, 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 blah. That's it. Real simple. There are buyers at that level. They like the price. You go to look for, you guys, some of you guys like, real nice cars. So you got a 911, GT4. The freaking thing is a $180,000 car. Well, souped up, it's 220. And that thing's at sale at $65,000. So you say, man, that's it. I don't care. Like, whatever, I'm putting money down. I'm buying that. You buy the Aston Martin DB9. $250,000 car, new. And it's been sold for 120. So you're like, whatever it takes, I'm putting some deposit down. There are buyers at certain level. Remember, in life, everything has a price. Like in a lot of the wild movies, Scarface and stuff included, every man has a price, right? At a price, everyone can be bought. And whether we like it or not, it's true. Not me, maybe. I don't know. Maybe I can be bought for maybe $10 billion. I don't know. I'm not selling my little puppies and my doggies for any money, but there's a price on everything in life. There's a price on every stock and the market. So when the price gets cheap enough, the money flows in. Simple. So let's think like that. Short covering and everything is a consequence of that. Just the shorts know that at that price, that the buyers are going to come in. That's the reason why they cover. Behavioral game theory. Let's move on to gold, which I want to show. Is that clear to everyone? Yes?
Yes, boss.
Yeah, because, like I said, simplicity is wisdom. And I try to practice it every day. So it's just like sometimes we got to really look at things in a very simple manner. Okay, let's move on. Let's not hammer the point too much. Gold. Best macro trade that I delivered to my people weeks ago. Gold was rock bottom at 1123. I didn't just come in here and say, oh yeah, it's going to go. No, mostly around here, 1130, 1140. These are the gold futures. That's the number you hear on Bloomberg or CNBC. I said gold looks like this is a big macro, and I have some fantastic charts on that I put out on my Twitter feed. Just go to the media, section, and you can just pull it out. I said this is a large macro falling wedge. I'm not a gold bug. I've joked around and said I don't sit around in a cave with a bunch of Budweisers and sitting there thinking the world's going to end. But I said, you know what? Gold is down from $1,300, and there, that was the picture. So that's a larger picture. That's the daily picture on gold, and I started charting it, and I said, well, J Nugget, gold miners, but direct correlation with actual gold prices. Remember something that happened about a year ago, guys, okay? Remember when we had the big oil collapse? What was happening to a particular sector of the U.S. economy, which was thriving when oil was higher, but suffering like nobody's business, and real human suffering too? What sector was it? Obviously some, in the oil sector, but what particular part of the oil sector was it? Come on, guys. You guys know the answer. I know it.
Drillers.
Yes, correct. That's one. And the other part? Drillers drill what? What was the biggest, when we are truly a self-sufficient energy nation after almost 30 years? Because of what part of the oil industry?
Shell.
Thank you. There you go. Corey's getting like freaking A+s all day long. Yes, shale oil. We dug. We have the best technology, sideways drilling. Forget about it. We're causing earthquakes in Pennsylvania like 50 miles away from where I am. Shale. Because this sideways drilling causes tremors and all that stuff. It's minor stuff. It's a small price to pay to be energy independent. I'm totally with it. So, yeah, shale oil. So what was happening when oil prices? Why were the junk bonds like going berserk? And there was so much fear that we would have an economic collapse because of a junk bond default, because of the shale oil industry borrowed billions and billions of dollars to do this stuff. So they needed a certain price point on oil in order to become self-sufficient. I mean, in order to basically what they call the break-even level, right? And just out of curiosity, anyone knows what that was by any chance? Like what price?
$45 a barrel.
Yeah, like $40 to $45 a barrel. You guys listen to this? Right? Now this is the oil picture. This is a perfect example of a beautiful head and shoulder. I mean, inverse head and shoulder. Left shoulder, left shoulder, left shoulder, left shoulder, neckline. Oil's going above, believe me, at one point this year, soon, oil's going above 65. So at around the 40 level, which was basically the shoulders on a technical basis, they would be able to survive. They will be able to survive. Now, why do you think I'm mentioning this when I'm mentioning gold? Can somebody tell me why I'm mentioning this? Because I'm mentioning gold?
Inflation.
No, because gold is the same picture as oil. Gold miners would be completely massacred if gold doesn't reach a certain level. And that level is, take a guess, just like shale oil, they would completely blow out and cause, and the gold miners didn't borrow that much, mind you. But they would
1220?
Yes, 1200. 1200. Below 1100, it would be decimation central, whether it be ABX, Anglo Mine, and blah, 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 and all those companies. And that's it. It's not a major sector of our economy. It's not like we're putting gold in our cars to drive it, but it is still important. So yes, the break-even cost on gold for the miners to extract the gold, because gold is a pretty expensive process to extract. Actually, less expensive than shale oil. It was 1100 was the mark. Where did gold bounce from? And I'm showing you a technical chart. 1120. It did go to 1042 back on November 30th. So it did break below that. So it's a matter of supply and demand. If you remember the basic economics classes that all of you took at some point, it's a matter of supply and demand. Gold demand doesn't just go higher because somebody says, you know what, I'm just going to buy more gold because I like it. It happens because it's used as a risk premium, as a safe haven, and many countries out there, including in the Middle East and India, they like gold. Americans don't really buy gold. In fact, American gold is actually the worst form of gold. You know, and I mean the cheapest quality of gold. Does anyone know why? I mean, why it is? I mean, gold is measured in two major calibers. What is it? Does anyone know?
Carrot.
No, carat is diamond. Don't ever tell your wife that, okay? So, who was that, by the way? Is that?
Europe.
Yeah, okay. It's carat. Yeah, you're right. What the hell am I doing? I'm the one who's an idiot. It's 14 carat or no, not carat. Yeah, 14 carat and 24 carat, right? For gold?
Yep.
Yeah, so I was right. Sorry, your wife's with you. I take it back. You can slap me. So, so all right, all kidding aside. So yes, so it's 14 carat and 24 carat. So let me just make sure. 1 second. So the U.S. gold that's sold in the U.S. is yes, you're right. So is 14 karat gold. That's actually the lower that's like driving a V6. The real power gold, which is sold overseas in developing world and stuff, that they keep gold as a safe haven in China, in India, just the way we were. We used to hoard gold, the gold standard, right? We sort of said, okay, gold is the safe thing, is 24 karat gold. So the bottom line is that has very little to do with the prices per se, but look what gold's doing. This is a beautiful technical chart. This is one of the best macro trades you can do, and I've been saying it for weeks now. Look at recent things that happen. Beautiful. As we are speaking, gold is up $13. Is there a massive risk out there? Not really. Yeah, they're a little bit worried about, whether we go hardcore on the NAFTA and this and that. But look at this. JNUG tomorrow, ladies and gentlemen, will open up another 12%. When was the last time you see a stock consistently open up 6, 7, 8, 9, 10, 12%? So if you don't participate in it, because I'm consistently saying the upside is intact, that's your fault, not mine. And looking at pattern symmetry, it fell like nobody's business from 1300 down here. It is going to go back to 1320. But it's going to have intraday volatility, but I'm showing you the trend where it's going. So you want to make a real trade? Do it. Sit on it. You don't have to worry about what happens intraday. Now, the other thing that happens with this is the monthly chart, which is very, very, very important. Very important. Forget this large macro falling wedge and focus on this very large, this is called a Gartley pattern, by the way. You can look it up on the technical analysis side. It's called the Gartley pattern. And you don't see Gartleys too often, but this is one of them. Okay. Take this out. Make this clean. So here's your Gartley. Very large triangle. Uptrend line that was broken and tried to be recaptured back on January 1st, 2015, 2 years ago. Failed. And this is where gold came down to. Couple of things I want to point out. Whenever you have a very large ascent, this was 2008, November. The peak was almost 2000, 1923 on 2011. 3 years went berserk. Everybody, you couldn't turn the TV on without seeing some schmuck like we say in New York, telling you that you should be buying gold. It's going to 10,000. The world is ending. You should be buying, you should be pawning all your gold, stealing your grandma's little gold and selling it, and all kinds of garbage. That's when gold peaked. Remember that a couple of years ago? It was just like gold, 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 gold. That was it. Well, that's what happens in euphoria, you know, right there. Then you had that big sharp spike, and that was it. Other factors came into play, currency factors, blah, 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 you know, this and that. So now we are here. Here's your major, here's your UT1, uptrend line 1, 1100. That also happens to be where gold companies go completely bankrupt. Actually below 1,000, they go completely bankrupt. So the markets rebalance. Now we're bouncing. See that candle? So let me just focus in. This is real money at play. Imagine you didn't trade Google or Tesla or anything, all that other stuff that we trade, biotech, and just put a bunch of your money in JNUG at 4.5, 5 that I recommended to. You're up 100% on your money. 100%. Instead, you focus on intraday, like, ooh, it's going up, it went up 60 cents, it went down 60 cents. Gotta keep an eye on the big picture. So I'm showing you, I'm literally giving you money in your pocket. What you do with it, I don't care. You do with it. Okay? A major downtrend line, 50 fib, that's where basically where the fight happens, the 50% Fibonacci retracement. And where is that? 1300, and the downtrend line intersection is 1325. Is it possible that it goes to 1325 and gets rejected like we did back on August of 2016? Absolutely. But see this? That's not a candle you mess with, or you sit on and make your own determination that gold is going to crash. It's going higher. And that higher is 1300 to 1323. That's about 100 points from here. I don't need to say anymore. What happens over this downtrend line if it breaks it? I have no idea. If it does break it, then the next level of interest or will be testing this broken uptrend channel, but most importantly, the 61.8 fib. That's at 1450. 1450. Well, gold bugs will tell you gold's going back to 10,000, but I'm just saying from a technical level. Now, this is happening over a bunch of months, mind you. They're not happening over a bunch of days. So let's look at the daily. So on the daily, this is what is exciting. This is perfection at its best. Robotic. One drop candle. Eventually, it's going to wind its way back up to 1300. Is it possible that it completely, this channel here that it's rising breaks down? Sure, anything can happen. Anything can happen. Anything can happen. But this is a macro trade where you can sit back and just let it flow. Risk levels are rising. Risk levels as we get into, and this is the final things that I'll explain, as we get into February, is going to rise dramatically in the US. Okay, so we could, like I said, we could have a 4 or 5% correction, and gold is going to 1300, 1320, in my opinion, technically speaking. This pattern is going to get resolved. What happens after that? I have no frigging clue. So you have a lot of money to make right here. If you miss this, you still have room. Now, JNUG. Let me get this out. Sometimes things are put on our laps and we don't even do anything with it. So where is, I did it right, Nugget. Okay, Nugget I did, and where's the JNUG one? Okay, I'll do NUGP. It's fine because that's a clean example.
Can you type it in? Can you go back and type it in?
Yeah, I'll type it
The
in, but
search?
this is the same thing though.
No.
This is the same thing.
No.
Okay.
Oh,
Yeah. So it's showing you it's the same parameters. Yeah, give or take a few, it's just off by a few dollars, a dollar or so, the difference between that. It's the same thing. This is the most perfect classic technical chart that can be explained to a 5-year-old. Okay. If you ask them what this looks like, they're going to say it looks like a cup. So this is exactly what's going on here. You have a nice cup. You have a large, which I didn't draw on this thing yet, a large there macro falling wedge, and I've shown these like multiple times, so it's not the first time I'm showing it, but I'm just drawing it out. Let me get this out. A very large multi-month macro falling wedge. We got the wedge breakout. I alerted people to JNUG and Nugget, both of them, not at the bottom, not at the bottom. I won't lie about that. Not here, but mostly right around a little bit higher, like a little less than 6. The thing right now, tomorrow, will open above 11. Got 100% there. This is a beautiful cup and handle with a direct move. Don't know if it's going to happen like this, but if this is the pattern symmetry correlation that's going to happen, then it's going to happen in 3 fat candles on this. That generally means that there is risk levels in the and the dollar is going to basically collapse very fast. Risk level or safe haven premiums are going to rise very quickly. That means the markets are not going to do too well. So I think that's going to happen in February. So whichever the case, you almost have a 60% move if you're not in it yet available to you. And I also showed very clearly on multiple charts on my Twitter feed, which I'm going to bring over right now. 1 second, which showed bear with me 1 second, pulling it out, which showed where the support levels are. And this is not a hard chart. This is actually one of the easy ones. The hard charts are the Googles and the Amazons and the biotechs. Those are the hard charts. That's where the real work comes in. So here's your JNUG. There you go. And it's clear as daylight. I've put down the parameters for people who don't read numbers, the trading range. It's going to break out tomorrow at 10 plus. It was originally recommended at 5 and change. And these February 10, 17, 9, 10 calls are going to be up like, I don't know, 45% at the open. If gold is right now, gold is up 14 points right now. So this is a cup. This is the handle. And this is the breakout, which is happening right now. Now, will breakout be a rocket ship up? I have no idea. But it's a breakout. So from a standpoint, one thing that I asked somebody else earlier on today who's here is most of the movements in gold, just so you know, happen overnight, right? We talked about that earlier, right? So don't expect, you can place your positions during the day, but you have to always kind of position earlier because the biggest movements in gold and commodities, whether it be oil too, also happen during overnight, especially gold, because the biggest players in gold are overseas. All right, just be clear of that. So it's like currency trading. The biggest moves in currencies happen overnight, not during trading hours. Sometimes, of course, during trading hours. Most of the times, outside trading hours, right? After hours. So you have to always be positioned before. But it's a swing trade, and it's real, and you're seeing that in front of your eyes tonight. Look at this. This is a daily picture. What about look at this. Friday. What was Friday? Let me do the 15-minute. So this was Friday. So it's like saying buy price line at $11.98 and then it's up $10, $20 and moving. That's your move from Friday. All right. So that's it. I mean, selective issues. All right, guys. So it's 9:21 right now, and I'll take a question or two, and then move from there. Feel free to ask. I'm here. Anyone?
JP asked about Google ER this week.
I'm sorry, Jip. Oh, early thoughts on Google. Yes, I'm sorry, I didn't read that. Thank you. ERs are really a crapshoot, but my gut feeling tells me that I can't really tell you the actual price movements, but overall tech sector is going to be the biggest beneficiary of what's going on because they're not really held hostage that much to a lot of the measures that are being considered. NAFTA and stuff really doesn't affect Google or Amazon or Tesla. So looking at it from a daily perspective, this is certainly a very bullish pattern. It is creating a nice thing, a bull flag, in my opinion. So this could break out, but given what we are seeing with earnings and the craziness that happens after hours, don't be surprised if it drops 20 points and then bounces. Best way to play earnings, in my opinion, is to have a little bit of common. I don't care if it's 20 shares or 30 shares or 100 shares of these expensive stocks, right? And then you can control the movements. Let's say you have 50 shares and the thing jumps $30 before it drops 40. Hey, you just made yourself $1,500 right off the bat. Or if you have 100 shares, if it jumps $20, you just made yourself $2,000 before it drops because there is going to be severe volatility. Overall charts are good. I have no complaints about that. So Google's early thoughts is it's positive. I think they're going to be a beneficiary of what's happening. But the hourly range trading, this is the range, 832, 820. Unfortunately, even as somebody who's such a strict disciple as I am on technical analysis doesn't always work on 20-minute craziness after hours after earnings, right? We all know that. But overall, that's your range. Your range is you buy the crap out of it unless they really croak and say some really stupid things, which they haven't because Zoe, I forget her name, their CFO comes from Morgan Stanley from 2 years ago, is one of the finest fiscal CFOs, conservative, and Google, I think, is dropping a lot of their garbage projects, as in, spending billions trying to build houses on Mars. I don't know what they're doing, but all that garbage products and focusing on their core business, which is search advertising, their phone business and stuff like that. So I think her name is Zoe, something Zoe, the Google CFO. She has done a tremendous job of guiding the conference calls in the right direction. So I'm positive on Google. So here's your range. Your range is 820, 832. That's 12 points. If Google breaks the breakout level here, 1 second. If Google breaks this breakout level here of 815, you can short the crap out of it till about 800, easy, because that was a major breakout line, as we know, back on January 6th, beginning of the year. So there's your trade. Very range bound, very technical, but that's where we are. If it breaks out over this, you should expect to see Google at, bear with me 1 second, at 845. So we're talking about 20 points on the upside, which is already not that exciting if you really think about it. But that's, you still make money on it. Downside is limited, upside is nice. And looking at the weekly chart on Google, it's good. It's positive. I can't really tell. 840, if it breaks over 840, see you later. It goes to 860 real fast. So we got about 20, 30 points on it on the upside. On the downside, we do not necessarily want to break the we don't want to break the 816 level, because on that note, you could trade, you could basically short it all the way to 790 to 800. Here is something I don't do. I don't like shorting these powerful stocks because they are nuts. Okay. And when the fund managers come in and they say, oh, it's down $15, let me just put $500 million into it, we're screwed. So I don't like shorting. I'd rather short the S&P, have a decent ROI, very nice, decent ROI on those moves, than short the Googles and the Amazons and try to make money off them. I know there are people out there trying to do it, but good luck to them. Most of the times they're losing money. So that's my picture on Google. And looking at the monthly chart, giving you the bigger picture, it's certainly on a major bull run. 1 second. Yeah. So there's nothing wrong with the monthly picture. Okay. What I like is the Tesla chart. I think Tesla is a big beneficiary of what's going on. Very simple. Here are my reasonings behind it. Tesla is the only company in the U.S., one of the major tech companies that does everything in the U.S. Made in USA, employs U.S. workers, largest gigafactory in the world, meaning largest automated factory in the world, where people still have to manage it. They import any, they don't outsource anything. That's huge. And on top of that, their biggest competition, Faraday, which is mostly Chinese owned, beautiful, beautiful cars. Faradays look like frigging Ferraris, because the normal Tesla is not really a nice, in my opinion, kind of boring looking car, but is going out of business, which is great news for Tesla. So I believe that, I'm trying to remove all the patterns here. I believe that Tesla is going to be big, and he seems to be in bed with the Trump team, which is great. So let's look at this here. This is the monthly chart on Tesla. Internals are showing still wants to go higher, which is good. Quick snapshot of the internals. Nice buy volume every single month, December, January. Here's your, big number of shorts, more than 20%, right? More than 20% still. So, and a lot of haters, like, I hate Tesla to death, they're just a scam job, and they're all fake news. I mean, come on, I don't give a crap about Teslas. I don't even like Teslas. But to berate Elon Musk for everything that he does is kind of stupid, if you ask me. His wives can do it because I think he's divorced two of them. But for investors to do it, they've been doing it since it was $36. Okay, end of story. I think does that not say it all? And there are people in there, including analysts on Wall Street, who think Tesla should be a $60 stock. Well, good luck. I mean, what do I know? But since here, just so you know, ladies and gentlemen, since 2013, they've been telling the world that Tesla is a fake. They can't sell cars. That GM's butt ugly Volt, which is the ugliest looking car in the world, will take them over. Well, good luck. Okay? They've all lost. So what do you have to say? It's overvalued, total scam. Well, I'm not that smart. Maybe some of you know better. Okay? People have tried to convince me that it's the worst stock in the world, to short it through Kingdom Come, it's going to fall, it's all a scam. And then, Trump's going to come to power, when he wins, he's going to basically say that green energy sucks. He didn't say anything like that. He invited Elon Musk to the Trump Tower. So this stock is good for 275 on a technical basis, and I think is the best reward for the money. Tesla options are cheap. You don't have to, it doesn't cost an arm and a leg to do it, right? So that's it. So this is good. Second candle, third candle, 275 gets to us the highs. At least breaks this. We got 269. Well, whatever, 270. I think it gets there. If it breaks down, the way to short Tesla is if it breaks 184, crap the like really short the crap out of it all the way to 150. But till that happens, good luck for all the dogmatic haters of Teslas. So that's it. Amazon, last one I'm going to cover. I have no idea what Amazon's going to do. And all I know is when you look at the monthly chart, it certainly looks like it wants to go higher. We've done very well in Amazon overall. No question about it. The candle is very positive. So 808, this is the level that Amazon has to decimate in order to go higher. 850. For a $40 move on Amazon, it needs to go up 5%. Not asking for the moon, right? If it breaks below 708. If it breaks below 748, that's roughly 60 points from where we are right now. You can short it all the way to 700. Is it possible? Anything is possible. Amazon might say something stupid like they have drones in Mars and they're delivering to Martians that don't exist. I don't know. Might say something stupid like that. Companies do that, and Wall Street hates it when they spend on things which are way too much in the future. We don't know that. But that's your monthly. Let's look at the daily. The daily is a range, just like anything else. That range is 740. Well, it's not 748. I'm not going to go there. It is there. It does look like a head and shoulder. That's what a bear will tell you. Head, left shoulder, or you can say left shoulder, right shoulder. It needs to break over 815, 820 in order to recapture this zone. Here's your neckline. If it breaks below 8, it's not really 805. It breaks below, I would say, 795. It's falling hard. But otherwise, it's just very range bound. It's very range bound. So that's it. All right, guys. I put a lot of stuff out there. Lessons to learn from this session. I know we drifted on for a while now. Is gotta track the levels. Get to be great friends and bedmates with your E-minis, SPX. Track my charts that I put out in the morning. I show the levels exactly. 90% of the time, you'll see the markets trade in between those levels. You got to be quick. Make money on the moves intraday. You're going to be severe volatility. We are down 6 points on the E-minis. We are holding that pivot. Gold is up $13, but don't expect another $13 in the middle of the day. I mean, at the open. It probably has made its big move already during this session. Okay. I think the Trump administration and the team they're putting together will benefit corporate America and overall U.S. growth, but they have to deliver. And I'm watching it very carefully. Trust but verify. That's the Reagan doctrine, right? So on that note, guys, pass the word around. We do a fantastic job what we do, and throughout all this volatility, we're delivering numbers that most services can't even dream of. And I'm not even boasting. It's all there. You have to be selective. Keep your trade sizes small. And in the meantime, you know, we're all held hostage to luck. You know, we got to be lucky. But luck comes with technical analysis. All right, guys. So have a great evening. Thank you for everything. And I mean that. Bring the, you know, we have a lot of new members. Bring on more and continue to, you know, learn and adapt. Thank you for listening. Have a great evening.
Thank you, Frank.
Thank you, guys.
Thank you.